It's a small group, so we can actually possibly even do a kind of introduction with everybody. So, which we'll use the opportunity to do exactly that. So thank you very much for coming. We'll speak in English as announced, but we can also switch to German between for technical explanations. What we'd like to talk about is climate transition investing. So how you actually invest in a way that gradually you shift billions, at some point trillions, towards a transition path that works and away from one that doesn't. Now, since we're only 8 people in the audience so far with us, who is familiar with investment funds? Can I get a quick show of hands? Reach a little bit. From Sparkasse or Vereinsbank or something like that. So, has anyone ever bought a green investment fund?
Sold.
Huh?
Sold, but before.
You sold one? Okay. Which one did you sell?
No, that was a private placement.
Oh, okay. You sold a private placement green. Okay, all right. So, you sold one within, okay, but that's very important for us to know. Okay. So we can organize at the right structure. So we'll start with a round of introductions, and then we'll explain why this topic is hugely important to get billions or trillions in the right direction. So my name is Andreas Hoppner. I'm a professor of operational risk banking and finance at the University College Dublin. Thank you very much for joining us. Please, everybody, join us to discuss investing, and we'll start further.
Hi everyone, I'm Lara. I work for the NGO Reclaim Finance, which is a research and campaigning organization based in France. We focus on the financial sector, noting that finance will be and is very important in the fight against climate change, and also noting that mainstream finance is still quite far from shifting in the right direction in the fight against the climate crisis. I focus specifically on the investment sector, and so conducting research on how investors are shifting their activities, publishing reports about this, sometimes denouncing activities or investments, and also producing recommendations for financial sector, but also engaging with the financial ecosystem on these topics. And yeah, just to share a tiny bit more on how I came to the NGO world, I used to work on auditing of financial institutions, and was quickly, let's say, surprised and a bit worried to see that existing regulations and standards around financial institutions were not going far enough to make sure that investments were shifting in the right direction. And so now have been working for years for this NGO. I'll stop here.
Hi everyone, my name is Arne Nemrich. I'm heading a team in the state of Baden-Württemberg, Land Baden-Württemberg, in the finance ministry, and we manage about 40 billion in debt of the federal state. And to do that, we also issue a green bond once a year. A green bond is a way of investing directly in the expenditure that is adding to the environmental sustainability of the state. And on the other hand, I'm responsible with my team for about 12 billion of assets that we invest on capital markets that are earmarked for future pension payments. And in that context, we also had the task last year to write a law on sustainable investment for all entities of the Land Baden-Württemberg that invest on capital markets. And one important issue in this law was the decarbonization of the portfolios, which is also the topic of today's discussion.
Hi, and welcome from me as well. I'm Fabiola. I'm assistant professor in accountancy at University College Dublin. My research usually looks at climate finance, more specifically fossil fuel finance, so how we can leverage the financial system to drive the energy transition. My PhD was already on transition finance and accounting, so this intersection is really what I'm looking at. besides research in academia, I also try to apply this research and drive real-world impact, if you wish. I do technical advisory at the European Commission level. It's the platform on sustainable finance, and that looks into transparency regulation, because in order to be able to invest, you need a lot of data. You need to know how do firms perform, how does finance work, and the data, that's what this regulation is trying to make mandatory, so that companies have to disclose the kind of data you need to make the decisions. The last thing that I then want to mention in this context is that we also do research on greenwashing. We have this Greenwatch AI initiative that applies AI to the financial markets to detect greenwashing, so reflecting what do companies say, what are the claims that companies make in terms of their sustainability versus what's the actual performance. Because there's often, unfortunately, a stark contrast between words and actions, and that's what we try to detect at larger scale rather than just on a case-by-case basis.
Hello to everyone. My name is Steffen. I'm the CEO and founder of Solactive. So Solactive is a Frankfurt-based index provider. So for those who are a little bit familiar with the investment business, index business, you've got a few big players like MSCI, S&P, you might have heard these names. So Solactive is the disruptor in that space. We started approximately 17 years ago. And to give you some numbers, we are in the meantime around 350 people in 7 locations all around the world. We calculate roughly 30,000 indices that are used from financial institutions. And we are also a very big and active player in the ESG and carbon investment space. We've launched a broad variety of indices in that space. And last but not least, we are also an investor in a variety of data companies. Amongst others, we, for example, invested in companies that are active in biodiversity and producing and creating data points in that space. So we've got a pretty strong footprint in that area.
Thank you very much, everybody. We'll try to anchor this panel in a structure that it makes sense. So, who is familiar with scope 1, 2, 3 CO2 emissions? Okay, let me start. Basically, scope 1 CO2 emissions are the emissions of an organization. Scope 2 CO2 emissions are the emissions of the electricity they consume but buy from another organization. And then scope 3 is the entire supply chain and the value chain towards the customer. So one of the things that's quite relevant in decarbonizing investment portfolios is that you take investment portfolios, which is 3,000 firms, split up into, say, 100 billion, and these 100 billion all buy parts of the firms, and then you gradually try to reduce the weighted average carbon emissions of these portfolios. So in many ways, maybe just to start with some background here, companies finance themselves via bond markets. So they basically go to the bond market and they ask for money to be given to them. It's Anleihe auf Deutsch. They geben Anleihen aus. They can also finance to an extent via the bank, and they finance via the stock market where they're equity investors. And so all of that money needs to gradually shift towards a decarbonization structure for this all to work. And one way to do this, which is central for the European Commission, is to actually create reference benchmarks for the climate transition. So from the European Commission's perspective, there is hopefully the Green Deal. Has anyone heard of the Green Taxonomy? Green Taxonomy? Okay, perfect. So it's a similar thing to the Green Taxonomy, just that it focuses predominantly on CO2 emissions. And there is specific benchmarks following, which are called taxonomy-aligned benchmarks. So what we do is, for Viola and me in particular, we work in the technical expert group that writes the taxonomy and that develops the tools that actually help decarbonize. The taxonomy itself is a dictionary of what is green or what is not green, and the benchmarks decarbonize portfolios more or less in line with the taxonomy. So we'll try to bring together the green taxonomy on one side and carbon emissions with how this runs through an investor portfolio and why this matters a lot. Because the one person that any CEO will listen to is the investors. Have to, right? They're investors and they're bondholders. So, and the tool that was strongest, because the taxonomy isn't 100% ready yet, are so-called Paris line benchmarks. We have 200 billion of Deutsche 200 Milliarden invested in Paris line benchmarks worldwide already, and they decarbonize portfolios around the world. Thank you very much. Here comes also an actual investor from the DBU. So the 200 billion are decarbonizing, and we're trying to get more and more money into the Paris line benchmarks. So we'll basically try to bring this back to the taxonomy. So just to briefly explain it, we're trying to bring two communities together here, green taxonomy community and investing community. I'll start with Stefan. Stefan, as the CEO of Selective, how does an index work, an equity index?
Well, we are now trying to achieve in a couple of minutes what I'm trying to explain my mom for 17 years. So let's get started. I guess an index overall, let's start with the most popular and the most visible index in Germany, which is the German DAX, yeah, that you see in the evening in the news where the DAX is based. So an index is essentially nothing else than a set of rules that is applied to a universe of stocks. Yeah? If we are looking into the DAX, very, very easy and simple, the DAX is a reflection of the value of the 40 biggest companies in Germany. So essentially, think about us as an index provider and think about a very big Excel spreadsheet. Index providers are doing nothing else than using a spreadsheet and doing the following exercises. Let's take the example of the DAX. You take all the companies based in Germany. You take the value of all the companies based in Germany, then you do the exercise by ranking from big to small, and then I'm always joking, then you've got the very big intellectual challenge to count from 1 to 40 to pick the 40 biggest names in Germany. So essentially, each and every index is a set of rules that we apply. Let's take another example, the S&P 500. It's the 500 biggest names in the US. So overall, each and every index is a reflection of the value of a set of stocks. Can be US stocks, can be German stocks, or can be stocks that are very carbon efficient, or also portfolios that decarbonize over time.
To make this very practical, can we take DBU as an example together with Land Baden-Württemberg? Would that be okay? Yeah. So perfect. So we have two actual investors in the room right now. We'll start with Land Baden-Württemberg and then we go straight to DBU itself. Which indexes are you using, Armin?
We actually almost would have used selective indexes, but Selective wasn't successful in the tender, so we used a competitor with the Stocks, and Stocks is part of Deutsche Börse Group, and they provide two indexes to us, one for European companies, that's the Paris-aligned benchmark stocks index for European companies, and one for outside the Eurozone. And each of these indexes has 60 firms in our case. That was just our own specification. So in total we hold 120 companies based on the index that is calculated, and the index keeps all the rules that the Paris-aligned benchmark regulation includes. So the goal is 7% decarbonization year on year.
Okay. In Europe, our investment universe is the Euro Stock 600, and in US is the S&P 500.
So you have these overall indices, and these indices have a certain carbon intensity, and they have a certain ratio of green taxonomy in terms of revenue or in terms of capital expenditures. And so, if you want, so the meta game is how do we get the carbon intensity of these indexes down? Arnie just pointed out there's a 7% reduction, which is overall step by step, and Fabiola will now explain to us why this is important from a theory of change perspective.
So what we see is a big shift in investment. When you think of investing, you probably picture someone sitting in an office doing a bidding analysis and then picking companies individually. It's very expensive and labor intensive. So that way shifting capital is very hard because you need to pick stocks individually. If we have these indices, we can do passive investment. And that's a big change because this makes it much cheaper because we just track an index and therefore we can offer financial product at much cheaper prices because we save on all these labor and analysis costs. The word that we're using here is ETFs, usually exchange-traded funds, and they've been praised for democratizing finance and making it possible for each and everyone to invest easily in a large basket of companies. So rather than you having to go on an app and pick companies individually, which can be very expensive, you can now easily invest in a whole basket of companies, such as the S&P 500 or a basket of companies that is on this trajectory to carbon neutrality. It's not just cheaper, but it also has a lower access point for you because you can invest as little as $1 in the entire basket of 500 companies. If you were to go out and actually buy each individual company, a share in each of those companies, most retail investors, most of us couldn't afford that just as easily. So it's enabled us to invest and shift capital much more quickly because it's passive investment rather than active investment. That also means that if the average shifts and if the S&P 500 changes, a lot of money automatically changes. We don't need to go there and pick individual companies. We just follow the big index, and therefore we can shift capital very efficiently and very cheaply.
Now, on a side note, who owns the world, right? When we talk about a financial system, who actually owns it? It's three groups. It's retirees, pension savings, and a lot of the money on in your case will be retirees, right? It's insurances, where you pay premiums, and it's foundations like DBU. Adding all together is a huge amount of money. Can I ask, are there any questions so far? I'm quite aware that we might be quite technical here. Yeah, please.
My question would be, where are we standing? What is the perspective and what obstacles are still there so we meet the climate targets?
Okay, that's a very good question. So where do we stand? Are we on the path to the climate targets? So the European Commission, when they also developed the Green Taxonomy, put forward an instrument called Paris Line Benchmark, which decarbonizes 7% year on year. So you can calculate if you start decarbonizing 7% year on year from 2020, 2023, 2024, by 2049, you're pretty close to zero, and then of course you need to get rid of the rest. But so that in itself would meet the Paris targets if everything was invested that way, which of course at this stage it's not, so it's hugely important to grow the instrument and to make more and more investors aware of it. We have two instruments. One is called Paris Aligned Benchmark, the other one is called Climate Transition Benchmark. And so that is the path that is offered in a variety of different structures. Now, we're not only having investors, index providers and academics, we also have campaigners. Lara, how do you guys think about this from a Reclaim perspective?
At Reclaim, and as Andreas was saying, finance can get quite technical and hard to understand for citizens or even individual savers, citizens that also all have banks. And so you're part of the financial system. And at Reclaim, what we're aiming at doing is to try to play a citizen counterpower as well in all these topics around how do we shift finance to finance the transition, how do we make sure that all this green finance, sustainable finance that I'm sure all of you have heard at least once, maybe your bank is also saying that it's a green bank, and there's a lot of marketing around it. And what we want to do is make sure that this is not all greenwashing and that investments and financing is really shifting. And so, of course, sustainable finance is about having having more green funds, green products, and making sure there's more investments in renewable energy. We need this, but it's also about making sure that the entire financial system is shifting and is reducing, phasing out the investments going to the worst activities, the activities that are worsening the climate crisis. So one of the things we do at Reclaim is to point out and recall the red lines that are drawn by science and that we already know. So for the financial sector, one of the key things that we know is that no new fossil fuel projects are needed if we want to limit global warming to a 1.5 degree. And it's part of our job to recall the amounts of financing and investments that are still going today into fossil fuel expansion, and calling for these amounts to be reduced, for the support to be restricted. And this is including for German financial institutions. In our research, I mean, it's everywhere, unfortunately, but even in Germany, the biggest banks and investors here, asset managers, are still giving new support to fossil fuel expansion on a very regular basis. So this is also something we want to call out. And the second thing we also want to do as an NGO is to go a bit further and propose alternatives, recommendations to financial institutions that are willing to make progress in this matter. And so, yeah, we really try to understand the specificities of each type of financial institutions. And this means dialoguing a lot with different types of stakeholders.
Can I bring the investor perspective back in? I think you've done sustainable investing for 20 plus years, maybe 30 at DBU? 30 years. Do you want to briefly summarize in 3 minutes what the main learnings were from the last 30 years of sustainable investing? And then I'll come to Arnim, which I think is 5 to 10 years, if I'm correct.
We start with our foundation in 1991, and the first 10 years we do nothing in sustainable investment. We started with the year 2003, and from 2004 we had sustainable guidelines which were integrated in our asset management guidelines. So we started with exclusion of some equity. We started to say that 80% of our equities and 80% of our corporates has to be included in one of the sustainable index rankings. And so we use at this time the data of Ökom, what's now ISS, and from Sustainalytics, and today also from Refinitiv, what was former Reuters. And we developed it step by step. So we made in 2015 an exclusion of coal investments. We started investment in renewables. Today we have 7% of our investments in renewables. So it was a development from step to step.
That sounds very good. Arnim, and how did you do it, and how did you become famous in the US?
Okay. First, maybe also some history. The Land of Baden-Württemberg is accumulating the funds that I talked about for the pensions for 20 years now. And also the first 17 years there were no sustainability criteria whatsoever. So the Land of Baden-Württemberg only started in 2017 to include sustainability criteria for the investment, much later than you. And it basically started with criteria that were used in the church investment space, because the churches were really the first investors that cared about sustainability when they invested their money. So it was mainly based on exclusions then, but we already had fossil fuel production exclusions starting in 2017. And then in the last coalition agreement in Baden-Württemberg, there was a quite ambitious goal formulated by the party parties, CDU and Grüne, and they wanted to align with the 1.5 degree target of the Paris Agreement. They wanted to align with the Sustainable Development Goals of the United Nations and with the EU Taxonomy. That was the objective, and my job was to make this concrete, which was more difficult than writing the objective. And that's why we developed a full-scale law for all entities, and we have numerous foundations in the land of Baden-Württemberg that have millions to invest, like 5 millions, 10 millions, and then we also have these large funds with billions to invest, which makes it quite difficult to make one rule in a law that applies to all of them. And then we basically defined what is our principal target, and our principal target was formulated as value alignment. So basically what we said is the land of Baden-Württemberg shouldn't invest in companies that do not align with the objectives that are pursued in other areas of the government policy. So if the land via the Bund is signing the Paris Agreement, then companies that we invest in should also commit towards the Paris Agreement. So that's the general idea, and I could go further in the specifics, but I'll keep it short.
Stefan, how did you get into it, and how does the Paris aligning work with Selective?
Well, I just remember back in 2009, and that gives you also a little bit of an explanation in terms of the history of, let's say, carbon investing and all of that. We've launched in 2009 in total 6 indices linked to corporate governance on the one hand side and linked to fossil fuel exclusions. The 6 indices raised in total 100,000 euros aggregated. So all of these indices were shut down a year after because overall no one was really interested. I guess you know the number a little bit more in detail. Today was the announcement that 180 billion are in the meantime only invested in Paris-aligned benchmarks, which is the regulatory framework of the EU. So there you can see there is a fundamental shift. There's a substantially higher awareness of investing in that direction than it has been 15 years ago. I guess if we are looking today how we apply that in within Solactive. First of all, of course I have to say, Arnim, we missed that one opportunity, but for example, we are also working here for the federal state in Berlin, where we are the index provider, so very important to mention. If we are looking into how we applied it within Solactive, first of all, you've got globally many different client groups. The terrible thing from my perspective is currently happening in the US, because in the US, climate investing is not a topic anymore. Either, I'm always phrasing that a little bit cynical, either you hate ESG, then you don't invest ESG aligned, or you love ESG, then you don't invest because you're afraid of being sued. So from that perspective, US currently is really dead. We have hardly any demand from the US. If we look into Europe, we see still a lot of demand, in particular from the asset owner space, because I guess that is something very, very relevant. Often it starts with the asset owner having big and substantial allocations in that space. Another market which is quite relevant is Japan, with GPIF, the government pension fund in Japan, also investing and taking into account a lot of ESG criteria, a lot of climate criteria. So overall, that is often the way how it starts, and we are directly working together with all the asset owners to really design their customized strategy in Europe, often based on the European regulation, which gives us a lot of guidance of rules that we have to apply to be overall compliant with the regulation.
Maybe to add to the regulations, so has anyone ever heard of ESMA? ESMA? European Security Markets Authority. They've just put something forward in Germany, they quote as BaFin, that from next summer onwards, if a fund uses the name Nachhaltigkeit, Umwelt oder Impact, then they're not allowed to have any more fossil fuel included than the Paris line benchmarks we're discussing here. So the regulation is working in the background to gradually get out of coal, decarbonize portfolios and so forth. Now, there is the important aspect aspect of which part of the asset classes we're doing that. But before I come to that, is there any further question? What are you trying to say? Yeah, please.
I had a question related more to the secondary markets or what is alternative investments. Maybe from your perspective, have you seen an increase in sustainable investing in alternatives? Maybe from your perspective, if alternatives play also not a big role as before, more in the US?
Okay, we'll start with Fabiola, then go to Stephanie on alternative.
I would actually say, why do we talk about secondary markets, which I guess was your question just before this. So my research usually tells you, forget about secondary markets. I don't really care what's happening there. It's about primary markets. Because where do companies raise money? It's in primary markets. That's the definition of primary market. That's an interaction between a company and an investor. So the actual moment where me and the company exchange money. Secondary markets, that's equity markets in their everyday life. That's trades between investors. So only an initial public offering, when a company goes public, they actually get money from the investors. After this, all the trades that we talk about and all the big numbers that we see in shifting of the DAX or whatever, that's secondary market transactions where prices are determined. But that's not changing company capital. That's not the company that does trading. It's always an investor with a different investor. And they just exchange money and the company share. Sure, that's important for the company because sometimes management bonuses are linked to this and so on, but that's all indirect effects. The company is not going to go bust because of secondary markets. However, if you're looking at primary markets, and now we're more talking debt, because initial public offerings, kind of like the name suggests, initial, it only happens once, and secondary offerings are very rare. Companies don't really do that. It's most about loans and bonds online, as we said earlier. That's where companies regularly raise capital. You go to your bank, you need a new loan. You know, if you have a mortgage on your house, you have to repay that. Every month, you have to transfer money. That's a more primary market transaction in that sense because you actually exchange money with your investor. And that's where it's important. And that's where companies are really in the risk of refinancing because if they don't refinance, they go bankrupt. Most companies have huge amounts of debt. Capital structure is a strategic decision. They couldn't pay this all back just if they wanted. Some of the older oil companies, they might have a lot of cash lying around. The big technology companies, they do, but still, capital-intensive industries, they need a lot of cash. So this is what we need to talk about, and this is where real impact can be had, primary markets, and that's what we should focus on and what's happening there.
Let's definitely the alternatives. Do you want to comment?
Well, not too much. Overall, if we're looking into alternatives, I prefer listed versus unlisted because alternative could be pretty much everything. Yeah. So overall, if we are looking into the unlisted world, I guess the listed world drives a lot in terms of, let's say, the pricing of unlisted. Yeah. And I guess if we are looking into the capital markets, and if we are looking into let's take Paris-aligned benchmarks, supply and demand. If we've got a capital allocation into Paris-aligned benchmarks, you reward the good companies, which overall means that in the long term, and that is the thesis, in the long term, you reward these companies by lower cost of capital, yeah, both on the equity and on the debt side. Yeah, I guess that is what we are talking about. I don't use the word alternative because theoretically every banker is defining something else amongst about listed versus unlisted, whilst the listed world is driving overall the cost in the unlisted.
Yes, please.
Maybe a more general question. If these environmental indices are really necessary, because I studied economics and in there basically what people always will tell is that we have these CO2 certificates and you can sell them, buy them, there's a market for that, and the overall how good the company would be would depend on how much CO2 they would emission. So is it basically that these indices are necessary because the CO2 certificate prices are too low? Because otherwise the revenue would shrink so much that nobody would invest in that. From a theoretical standpoint, right?
Everyone has opinions on that.
You're right.
So basically, certificates are not the line of Paris, right? Is that the main problem?
Well, first of all, Paris line benchmarks apply to global capital markets. So that's the first main difference. So what I would answer is that it's an additional regulation piece that adds to the general objective. They're not in conflict to each other, but in a world where everything would be regulated by certificates, you would probably not need it at all. If you drive the whole market by the certificate price. That's true. But we are regionally limited and industry-wise limited in the case of the certificates. So also transport companies, for example, are not included yet, but they are included in the portfolios we invest in. So that would be my main point there.
Well, as an index provider, of course, you need all of these indices, no doubts around that. Now, I guess it's the carbon, the CO2 certificate market is a quite interesting one, and many people have a little bit the illusion that overall I buy futures of CO2 certificates, and then I'm green. Yeah. The reality is, if you and if we sit here, I'll sell you a future, and you buy a future from me. Still the same world outside. We've changed nothing essentially. Yeah. So from that perspective, the CO2 market is, as Arne mentioned, it's regionally. Yeah. It's industry specific, and overall, as long as we don't have, let's say, a global regulation capturing everything, and I don't have that illusion that this will happen very soon. I guess new indices are the reflection of the markets we would like to allocate capital.
Just to very much add, I completely agree with what has been said, but the likelihood of getting a global carbon tax that is ambitious is so low that oil and gas companies publicly support the idea, because they know it's never going to happen. You can look up great YouTube videos of lobbyists laughing about this idea.
You can also think about it a step forward. So I had the pleasure of being in an advisory board with Lord Nicholas Stern, the economist who wrote the Economics of Climate Change. He would say we need 150 to 200 euro global carbon tax. If we had that, we may not need Paris line benchmark that urgently, although I would agree with Stefan, we need it certainly from an educational perspective. Now we're miles below that. And in many ways, what Fabiola was pointing out was the unline, the fixed income market. You can think of that as a notional carbon tax. It's not a direct carbon tax, but it's an indirect one, because it costs you more to refinance if you're in the coal industry. For instance, you won't get DBU support and many other people's support. And so in the coal industry, you may have certificates, but on top of that is the price of refinancing, and that's how you may get to 150. So excellent to have questions. Any further questions? And please come in, join us here. We are trying to get a full tent. We saw the tent before, and that was on Wärmepumpen, and that was full. Yeah.
I'm Lewis from CEP, and we did a recent report on how a lot of companies still that need a lot of access to capital to decarbonize in the energy sector or in the transport sector, they still don't have enough access to capital. And I'm curious just to hear from you, what do you see as some of the biggest hurdles to overcome for the companies that are demonstrating that they want to actually implement their climate transition plans to actually get enough capital to make that shift?
Who wants to pick up that question? Lara, do you want to try?
I can start. I'm sure you will also have things to add. So first, agree with the finding you have. There's still difficulty to access enough capital. The International Energy Agency was reminding us yesterday that we're still way far from the investments we need in renewable energies and green activities, and there are hurdles to that. So for sure, and here we're talking about sustainable finance, investors alone will not solve all the problems of the transitions, and we'll need the policy frameworks around it to make this possible, to reduce the risk of investing in renewable energy, for example. So here, European regulators, for example, have a big part to play, the central bank as well, in terms of the impact that it has on companies and the influence it can have to say, why should a fossil fuel company benefit and have the same rules in terms of raising money than a greener company? So there's, this is like big debate. I would say, coming back to investors, the money is out there, like available. There's enough money available from investors in theory to cover what we need for renewable energy. So one thing that we point out at Reclaim is that the money going to the worst activities that we still see going. Fabiola was talking about the primary market, so the place where companies raise new capital. We're still seeing that oil and gas majors today, when they want to raise capital, issue new debt, there's dozens and dozens of investors still buying the bonds and still being very much involved in there. So if there's more rules to stop these kind of financing, well, there's also more money for the green part.
I'll risk going very nitty-gritty. In the rules for the Paris Line benchmarks, we decarbonize 7%, but we decarbonize in two buckets. We got the heavy industry bucket and the light industry bucket. So if I, for instance, sell gas or coal in the climate transition benchmark, then I need to put that somewhere else, but I can't put it in consulting. So in essence, I am actually strongly incentivized to go into those heavy, where such as cement or other parts where the transition can occur. And so there is a mechanism by having these two separate buckets that decarbonize to shift money very much into that area. It also depends on how companies outline this. So we have an instrument which is called a sustainability bond. Enel, the Italian utility, similar to E.ON in a sense, put forward a bond where they said, if we miss our renewable energy target, we'll pay you investors more. And any company could do that if they dare. Not everybody does. They were on target to get it until the Russian invasion, then they missed it. Now they're actually paying more, which makes the instrument highly interesting. So, but I'd like to come back to one point, because I think it's just interesting for a general audience. Arnim, there were American newspapers that put you guys on the cover, and Heidelberg in particular was on the picture. Please explain us why.
Okay, you tried it once. I thought I got around it. Okay. We have some value-based exclusions in the law on sustainable investment, which are not linked to decarbonization paths, and these are especially focusing on the sovereign bonds, so Staatsanleihen. And for our sovereign bonds portfolio, we basically use the same logic that I explained earlier. We said, okay, we will not finance governments that do not agree with the values that Germany has publicly agreed to. And how do you agree to values publicly as a state? You sign a UN agreement on weapons, on biodiversity, or the Paris Agreement. So we basically filter countries by whether they have signed the same agreement as Germany. And we exclude the rest. Now, it happens that the United States has not signed the cluster weapon agreement. It has not signed the biodiversity agreement. It has not signed an additional addendums to the women's agreement, and it has not signed for a while the Paris Agreement under Trump. Now they're back in. So we cannot buy US treasuries. Now, our portfolio of bonds before was euro-based due to risk considerations, so we never had US treasuries. But the site picked up on that and called me when I was actually here in Berlin on my cell phone and said, oh, we're doing an article and we heard you going out of US treasuries. I tried to explain it, but they didn't really want to hear it, that we're not selling any US treasuries, and then it ended up on the page 5 of Die Zeit. It's this woran keiner denkt. I don't know if you know the category, and that's what Andreas referred to.
And the US newspapers.
And by the way, the last sentence to add to that of that article was, we also contacted the Ministry of Finance in the United States, but they declined to answer.
So I think that the question that I'd now be very interested from Dietrich, if you're okay, and the four panelists is where do we need to go next, right? So obviously this is an interesting trajectory. We're up to 180 billion from zero 3 years ago, or from 10,000 euro 10 years ago, whatever it was. But what do we need to do next? We've managed to double the audience during the panel. That's a great start. And now the question is, what do we do next? So I'll start maybe with Lara. What do we do next? And then I would come to Dietrich and Anna.
Yes, happy to take that question because there's a lot to do next. But so basically, for the benchmarks also, it shows that regulators and EU regulators specifically are more and more trying to tackle this shift that we need for investments and to fight greenwashing also in this space. But what our research shows is that we're very far from this shift right now. Just to elaborate a bit more on this, when we analyze the big fund managers, the big asset managers out there, their climate policies are still very weak. They don't give enough clarity on the direction of the investments are taking. And so globally, investments in the most harmful companies are still not slowing down or not enough. We were talking about the primary market important earlier, and just for this primary market, we only have tracked about a dozen investors today that have policies and have committed to deny debt. So to say no, if you're an oil and gas company doing oil and gas expansion still, and you're not in transition, it means we will refuse, we will not give you more capital when you need it. So what we need is to have more investors, big asset owners, big pension funds, being more clear that they want their money to be managed in a way that they agree with. And so having more policies, explaining the rules they have. And then it means also shifting their products, having better benchmarks, indexes, but this is maybe one first thing. And very quickly, a second part is that ESG and climate funds that are being sold right now, there's still also a greenwashing problem with the majority of them still being exposed to very problematic companies such as fossil fuel developers, so also a need for more clarity in that sense. Can a fund be called transition if it's investing in fossil fuel expansion? And there's still no rule worldwide to clarify this. So I'll stop here.
I've just one very quick question and then one very quick comment. Who's already invested in the equity markets? Who has invested in stocks or funds? Okay, so coming back to your question, how do we finance that? The reality is, from my perspective, let's just start with all of us. If we start to invest and not put our money on our traditional Sparbuch, if we start to deploy that capital, you will find out what is the best way to do. You will find out to invest in an ESG, in a Paris-aligned benchmark, whatever. And that capital allocation, first of all, I strongly believe it's beneficial for yourself. Secondly, I think it is beneficial for the overall long-term development of our world that we are living in. So I guess one of the big problems is if you are raising the question, you're spot on. How do we finance all of that? I guess it starts with all of us, and that is what we need to think about and what we need to consider as well.
So when you refer to the private investor here in the room or potential investor, then I refer to the institutional investors like us and all the foundations in Germany. I was just at a foundation meeting where all the investors or CFOs of the foundations were discussing sustainable investing. And you would think that foundations that have very ethical objectives in their main business, where they spend the money, would also care about that when they invest. But funnily enough, they don't. Most of them still invest like they did 30 years ago or 20 years ago. So what I always call for, and I think that's a major shift that still needs to happen, is that asset owners make sustainability an objective. Not a sub-objective, but an objective. And only if it's an objective and you are just as, you care just as much about sustainability outcomes of the investments you make as you care about the performance, only then you can also manage trade-offs and you can also accept trade-offs. I always like to make the example of investing in a mafia gang. Who of you would invest in a mafia gang if it was legally possible? It's a great business. Yeah?
If you consider the church to be a mafia, then I would agree.
No, it's a great business. Only problem is a lot of blood involved. Yeah? So think about it. You probably don't want to invest in a mafia gang, but many of us do if they buy worldwide index funds. They don't invest in mafia gangs, obviously, but they might invest in companies that if you knew about it, you wouldn't want to invest in them. And that's really the shift that has to happen on the institutional level and on the private level, to start caring about more than the performance number that you get on your account statement.
What's next?
So usually, being an accountant, I probably would have told you about transparency, mandatory reporting, getting that right information to finally hold companies accountable, and all of these things, make data-driven decisions. But I actually think I'm going to try to connect what my fellow speaker said and come back to what Lara brought up earlier about the European Central Bank. Because we did some research on how the European Central Bank reacted to COVID, the emergency power purchasing agreement. So the bonds that the ECB bought, that was quantitative easing, so they printed money, went to the primary markets and bought company bonds, directly giving money to companies. And we looked into, well, what kind of companies was that? Guess what? It's mainly the big major companies that we all know, which means a lot of dirty fossil fuel companies. This is also our money. We were talking about where do you put your personal savings, that's one thing, but then there's also your pension money. And there's also the money that the state spends, like the European Central Bank. They buy bonds directly on the market. And we should be very vocal as citizens about how this money is being spent. I don't agree with the European Central Bank spending essentially my taxpayers' money into quantitative easing, where they print money, we're talking a lot about inflation these days. This money was spent on bailing out essentially the fossil fuel industry. They loaded it up on very cheap bonds at the time, on very cheap financing costs. And the excuse usually for this is, well, it's just the average market. But by choosing the bond market as it currently is, you automatically exclude all new companies that haven't yet accessed these markets, that aren't yet as big, because they're new companies. And the companies that probably drive innovation and could lead to a better future. So rather than focusing on legacy and what in the past was very big, like fossil fuel, major energy companies, ask your pension fund, well, how do you spend my money? Where is this money going, and is this aligned with the future that I want to actually live in when I'm at pension age?
So to give the final word to DBU, hesitate, what's next? 2 minutes is the warning sign on the side from DBU.
Okay. First of all, so around 55% of our investments are bonds, and in the part of bonds, the most important segment are corporates, and so we are looking for green bonds. We have only 3 or 4% sovereigns in our bond portfolio. So today we have more than 300 million euro in green bonds based on EU green bond standard, and we look also that all the green bonds have reporting. Also, that's a problem today. Not every green bond has a reporting. They give you information what they want to do with your money, but they give you not in every case information what they had done with your money. And maybe sometimes there's a difference. Then we will strengthen also the renewables. So I mentioned that we have today 7% of our investments in renewables, and I think in 1 or 2 years we have more investments in renewables than in real estate. So I think there's main important points.
Thank you very much. So please join me in a loud applause for the panel. And I think we were on time. Thank you very much, everybody.